Depreciation is a loss in a value of non-current asset. There are two methods, reducing balance method and the straight line method. Let me teach you the easier method first, which is the straight line method for motor vehicle. 20% per annum. It means that you need to calculate depreciation on motor V. Depreciation on motor V equals 20% times cost price. Go and look for its cost price in the trial balance for motor V. This is labeled as 160,000 cost price here. Use this figure to calculate 20%. So it is times $160,000. 10% is 16,000, so 20% is 32,000. This figure is an expense item. You classify this in the income statement as an E item. At the same time, go up to motor V here, the accumulated depreciation on motor V. This was the previous year's depreciation, so we need to add on this year's depreciation, which is $32,000. So go up here to accumulated and add in 32,000. Because the asset lost 50,000 of its value in the previous years, and it loses another 32,000 in the current year. So the total accumulated depreciation becomes 82,000 in the balance sheet. Next adjustment, depreciation on fixtures and fittings, 10% per annum, reducing balance method. You will have to calculate the depreciation on this particular asset, fixtures and fittings. It is a 10% times cost price minus the current accumulated depreciation. Go up to fixtures and fittings. Take note of its cost price of 120 and its accumulated depreciation of 33,000. 120,000 and 33,000. So apply the figures into the formula. It is 10% times cost price of 120,000 minus of 33,000. Okay, use your calculator to calculate 10% times 87,000. This gives you a figure of 8,700. So since the depreciation is 8,700, depreciation is classified as an expense item in the income statement. Go to accumulated depreciation on fixtures and fittings over here. Add on this year's depreciation. This year's depreciation is 8,700. And it gives you a new accumulated depreciation figure of 41,000 700.